Okay, hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. We have made it to the third week, if you could believe that or not. Yeah, it's the third week. Wow, holy smokes. Time's flying by as it normally does during the middle or getting closer to the middle of the semester. And so I just want to call your attention to the classroom, just kind of talk about where we are and what we're doing and what's next. So we made it through the first 2 weeks already. Here we are in week 3. It's Tuesday, so the second day of the week already. What I'd like you to do, if you haven't done it already, is to look at the week at a glance, open up the instructional materials. You'll notice a couple of things here, okay? Don't worry about these videos. They're just there for supplemental information. Okay, you don't have to watch these, but they're there for you. They're LinkedIn Learning videos. Videos do not get submitted. They're just there for additional information. Okay, that's why you see them there. You'll click on the instructional materials. You'll find the PowerPoint presentation we're about to go through. You'll also find some additional information, some stuff I wrote up just to kind of help you out to better understand some concepts. There's a nice little thing link. You click on these and it shows you some information. It's just, just a little fun learning activity. And then we have the two videos I was just telling you. They're just videos, okay? They're just there to help to reinforce information for this week. Then you'll have the Engage and Explore. For this week, a couple things that I need you to be aware of. We have our first hypothesis for this course. Okay, hypothesis is an opportunity for you to watch a video and annotate it. If you have never done a hypothesis before, I want you to look at this part. This short video shows you how to use it. Okay. And so what I'd like you to do is you'll open up this hypothesis and just as the instructions say, make two annotations, two original annotations, and respond to two of your classmates. Very straightforward. So the way to make an annotation is you'll come in here. Oh, thank you, Maria. I see Maria's already done one. So Maria has highlighted here and started to and wrote a couple of short sentences. Very nice. Maria will do one more, and then Maria will also respond to two of you, two classmates, once you've done yours. Okay, this is exactly what I'm looking for. Very short, sweet, simple. Couple of statements, maybe a couple of questions. That's what makes these kinds of annotations fun and engaging. Okay, so Maria, great job as always. So Maria will do one more original annotation, and then Maria will respond to two classmates. Okay, when you do yours, I would like to encourage all of
Yes,
you. Go
oh,
ahead, Maria.
you say something? Say what?
Oh, so it was about the annotations, and I believe it's your other classmate Maria. Sorry, I think it was Maria R that made this post, right?
Oh,
It's no worries. Yeah, it's okay. It's a big class, right? Um, so yeah, so you'll create two original annotations and respond to two of your classmates. I would like you to do your original annotations by Thursday night. Yeah. Use that class time. Use that class time on Thursday to do the work, right? That's why you have that time. So, what I would like you to do is on Thursday during class time, create your original two annotations and hypothesis. Okay. And then, so what that does is will allow additional time for you and your classmates to respond to classmates by Sunday night. You see, so that's the logic behind the design. So again, if you have questions or you don't know how to do it, just let me know. But we do have the instructions right here, so you'll just watch this part and then you'll take care of the annotation. It's always important that in this course you go in order. Yeah, go in order. Don't skip anything. Look through everything in the class. Take your time with it, but you want to go through everything in the course. And remember, these Excel exercises, these are just for practice. Just for practice. These do not get submitted. Okay? They're just there to practice using Excel. Yep. Okay, and then of course you'll have the quiz for this chapter, just as you normally would. So without further ado, let's go ahead and jump into today's discussion on adjusting entries and adjusting um, our accounts through adjusting entries to impact our financial statements. I'm going to go good and slow because it's not always the easiest thing to understand. And of course, we'll go through a lot of examples. Mohammed, please.
Yeah, so I have a quick question, please. So there was a question in quiz two, I think. Yeah, quiz two. Okay, that says that uh, the rule of the debit ratio is liabilities divided assets. I mean, total liabilities divided total assets. Okay.
That's for the current ratio.
No, for the debit ratio. Okay.
Okay,
It was a kind of a tricky question.
tricky question. Yeah.
Yeah. So my answer was wrong because I said true. Okay. So I don't think that is going to be a big deal if it's the opposite. I think it's going to be the same result. I mean.
Yeah,
So
yeah, it'll be all right. I mean, it's just one question, and don't remember
yeah.
remember, Mohammed, if you haven't already, for every quiz, you could take it up to 2 times. So you could go back through it again if you haven't already, for a second attempt, and try it again. And if you
Ex-
go ahead.
Actually, I did the second. I did the second attempt also,
Oh, you did. Okay.
and I got the same mark.
Okay.
So
Oh boy. Well, that happens. Yeah, I wouldn't worry too much about
yeah,
it. It's only one question on one quiz. It's probably like 0.00003% of your grade. So
okay,
it's not even gonna really impact it.
okay, okay.
But I
I
have a quick
understand
question.
this.
Yeah.
Yeah,
That's a good question
that's good.
though. Yeah. You'll be
Okay,
all right.
thank you. Yeah, I was. Thank you, Professor.
You're welcome. You're welcome.
Professor, I have a question.
Marlon, yeah.
So, every week we don't have to submit a LinkedIn Learning certificate.
No, that's only in a few. There's only I think 4 in this course total. There's one in week 1. There's one in week 4. I think there's one in week 7 or 8, and then there's one toward the end of the course in week 14 or 15. So the answer to your question is no. There's not one in every week. There are LinkedIn materials in most weeks, but not LinkedIn certificates. So, for example, in week 1, you had your first LinkedIn Learning certificate, which was on Excel, right? Um, which was on Excel. Uh, and you also had a couple of videos that were just for in additional reinforcing information. So under instruction materials, when you see these, it's typically just for reinforcing videos, yeah? But in week 1, you had the Excel Essential Training. When you see something like this, and you open up and you see it's a series of very long, a series of several videos, there might be some quizzes, and that at the end, there's a certificate. That's a certificate, okay? We get to the end of that, you download the PDF and you upload it to this Dropbox. So every time you're in a week and you see a Dropbox like this, in that week there's a certificate. But in the other weeks, like for example, in week 2, you see these, those are just videos. So there's nothing to get submitted there. They're just videos. But when you see, again, you see like this Dropbox and you see a relatively lengthy series of videos, that's a certificate. Hope that helps to clarify that for you. It's a good question.
Thank you. I understand now.
Cool. You're welcome. Awesome.
Professor, it's Jordan. Did you get my
I got your
meeting?
email. I
Okay,
did.
yeah, because I'm still having issues with this, and it's just not. I've been through all the web browsers, and it's just not loading for me. So, and I don't want to lose points. So
Right.
I just want to see that you saw that we're meeting tomorrow about.
Yeah, I got you. Yeah, let's meet
Alright.
tomorrow, and what we'll do, Jordan, is I'll have you show me exactly
Yeah,
what's
that's
happening.
because I'm like, okay, I even did it now with you, and it's still loading while as I'm still talking to you. So yeah, when we meet tomorrow, I'll show you.
Yeah, and we'll figure it out. Don't worry.
Okay, thanks.
You're welcome. Thank you.
Yeah, Professor, this is Alhaji. I was gonna ask you the same question because it keep loading and it never came through.
Yeah, that's unusual. So, it could be it's probably a technical issue with either your web browser or the cache, the cookies. All of those things are possibilities. This does not work at all with Safari. So if you're using Safari, it's not going to work. You'll have to use either Chrome or Edge or Firefox. That's typically the problem. Another problem could be the cache or cookies. In that case, you might want to try doing it in an incognito type of, or what they call it, in private browser session, and that typically resolves it.
All right, thank you.
You're welcome.
Good try.
Yeah, give it a shot. Let me know. Otherwise, Leslie, just set up a time to meet with me. Just send me an email, and we'll figure out a time to meet so I can see what's happening.
Okay, no problem.
Cool.
Thank you.
Yep, absolutely. Yeah, the same goes for any of you. If you have, those type of issues, just let me know. Shoot me an email, and we'll set up a time to meet, and so that way I can walk you through it. So cool. Okay, let's go ahead and get started. We lost a little bit of time there, but that's okay. We'll make it up. All right. Okay, so this chapter, this part of the concept is about making adjusting entries, and the reason why in accounting we make adjusting entries is because we consume expenses throughout the year that we oftentimes pay for in advance. And we talked briefly about that last week when we talked about prepaid insurance. Oh, and hopefully you remember that part of the conversation. But that was part of it, yeah. So we'll talk about those, and we'll talk about why we make adjusting entries and how they're done. And really the whole point of today's conversation is to help you to understand it. I had also mentioned, and this might have been probably either last week or even the first day we met, was about accounting periods. The way that we report our income statement, balance sheet, statement of cash flows, and statement of retained earnings is every month. We go through the entire month, and throughout that month, we're making sales, paying bills, receiving payment from customers, uh, paying our employees, the normal day-to-day operations of business. And as those days are going by, we are recording those transactions. At the end of the month, we go through what we call the closing process. where we make adjusting entries, we reconcile our accounts, and then we start the next month. I have a full month of data, and each month is considered an accounting period. Okay? Every 3 months, we consider that a quarter. And I have 3 months worth of accounting data in a quarter. There are 4 quarters in a year because there's 12 months in a year. I can also look at my accounting data every 6 months. We call this semi-annual. It shows me 6 months worth of accounting information, yeah, from my company. And of course, I could also look at the entire 12 months. We call that annual reporting. In accounting, it's super important to look at your income statement, balance sheet, statement of cash flows, and statement of retained earnings a couple of different times throughout the year. I look at it monthly, quarterly, semi-annual, and annual. And the reason why I look at the data that way is because I like to compare. Yeah, this month compared to last month, this quarter compared to last quarter, this year compared to last year, you see. So that's why we report it this way. An accounting period can be defined as a month, a quarter, semi-annual, or annual. Okay. Oftentimes it'll specify, a month, quarter, semi-annual, annual. But these are what we consider the accounting periods. The reason why it's important to understand what the accounting periods are is because there are 2 methods that are used in accounting to record transactions. There's the accrual-based method and the cash-based method. And depending on the type of company that you're operating in, you're going to use one or the other. Accrual-based accounting is when we record the revenue when the goods or the service has been delivered. We call that earned revenue. It's earned. We record revenue when we deliver the good or the service. That's what we call revenue. We cannot record revenue before we deliver the good or the service. That's called unearned revenue, you see. So in accrual-based accounting, I record my revenue when I deliver the good or the service. All right. And I record my expenses in the month, accounting period, that they happened in. Okay, here's what I mean by that. Let's say you get your Pepco bill, your electric bill, okay? And the electric bill is for, we'll say, January 1st through January 31st. I didn't get the bill until February 10th. February 10th, I got my electric bill for the month of January. That's usually the way it works, right? You get the bill a couple days after the end of the month. I don't record that expense in February. I record it in January because that's when I incurred the electric expense, you see? So I would date that bill in my accounting system for January 31. Because that electric consumption happened in the month of January. Didn't happen in February. I got the bill in February for the electric I consumed in the month of January. So I date that bill in my accounting system January 31 because, and this goes back to the matching principle that we learned about in chapter 1, I have to match my revenue and expenses, right? When they happened. So according to accrual-based accounting, I need to record my sales after I've delivered the good or the service, and my expenses when they were incurred, when they actually happened. Okay? That's accrual-based accounting. The majority of companies use accrual-based accounting because it is more accurate in reporting, right? It talks about actual consumption. We look at actual revenue when it's earned. Accrual-based accounting also uses specific accounts like accounts receivable and accounts payable. Accounts receivable, as you remember, is when we've made the sale, but the customer has not yet paid us. Okay, we call that accounts receivable. We expect to receive the cash from the customer in the future. Accounts receivable. In accrual-based accounting, we also have accounts payable. This is when I received the bill, right, for my electric, but I have not yet paid it. That's what we call an account payable. I owe it. I haven't paid it yet. You see? That's all a part of accrual-based accounting. On the other hand, we have a different method of accounting that some businesses use called cash-based accounting. Here's the difference. In cash-based accounting, I record my sales revenue when I receive the cash, and I record my expenses when I pay the cash. Okay? Here's why it's better to use accrual-based accounting. If I use cash-based accounting and I record my sales when I receive the cash, that can overstate a month by that amount. Or if I pay the bill, that can overstate my expenses by that month, by that amount. For example, let's say I made a sale to a customer in the month of January, okay? That customer didn't pay me until February. Based off of the cash-based accounting, I record that sale in February. In reality, I made it in January. So it would overstate my January sales by that amount. With the expenses, I received my Pepco electric bill on February 10th. It was for the consumption of electric back in January. Based off cash-based accounting, I record that expense in February. That would overstate my expenses by that amount in the month of February. You see? That's why most businesses use accrual-based accounting because it's more accurate. It reflects the actual consumption of expenses and it reflects the actual sales, right? The timing is everything, you see? So just keep that in mind. That's the primary differences between the two. It really depends on the type of business that you're operating. I have a student who owns a catering business, okay, food catering. And she asked me, Dr. B, which one should I use, accrual or cash-based? I said, well, it depends. It depends on the level of complexity of the business. It also depends on when your customers normally pay you, how they normally pay you, and it also depends on how you normally pay your expenses. That will help you to determine which method is better for your business. But it's also important to note that the only method that is approved under generally accepted accounting principles, and of course for the IRS, is accrual-based accounting. So that's the primary difference between the two. But for all intents purposes, especially for this course, we're going to focus on accrual-based accounting. Okay, accrual-based accounting. I'll show you the differences between the two in a few instances, but again, we're going to focus our attention on accrual-based accounting in this course. Here we have an example of accrual-based accounting. Prepaid insurance. We talked briefly about this last week. I personally like to prepay my insurance for the whole year in advance. Okay. The reason why I do that is because I get a discount. You pay it up front, they give you a little discount. Yeah, that's one of the benefits of paying up front. Okay. That's just me. Some people don't like to do that. I do. Or sometimes you have to. Sometimes you got to pay it up front and it covers the whole year. So here we have an example. For my business, my insurance is $2,400 and it covers 2 years, okay, 24 months of business. That's a good deal. If you think about that, $2,400 for 24 months, if you divide the $2,400 by the 24 months, that's $100 a month. Okay? Because we use accrual-based accounting in my business, we need to recognize the consumption of that insurance expense when it is incurred, when it happens. Okay? So let's say I prepay my $2,400 of insurance on December 1. Okay, and it covers 2 years. December 1, I paid the $2,400, covers 2 years of insurance. At the end of every single month, I need to recognize the consumption of that insurance expense because of the matching principle, right? So the way I do that is I create a journal entry where I debit insurance expense to increase my insurance expense by $100, and I credit prepaid insurance by $100. What that does is it increases my expense for the month for insurance, and it decreases the balance of my prepaid insurance expense. Okay. So the very first transaction on December 1 is I debit prepaid insurance expense and I credit cash by $2,400. Every month, at the end of the month, I make an adjusting journal entry by debiting insurance expense by $100 and credit prepaid insurance $100. I make that same journal entry 24 times. Okay, that's one time at the end of every single month for 24 months. What that does is at the end of the 24th month, my prepaid insurance balance should be zero because it recognizes the consumption of that insurance every single month by making that journal entry, that adjusting journal entry. Does that make sense to everyone? Are we pretty clear on how that works? Yes, no, maybe? Any confusion? We're okay? All right. Just making sure, y'all. Okay, so that's accrual-based accounting. To show you the cash-based accounting example of this is very straightforward. Okay? Because it's cash-based, we recognize the expense when we pay it. So I paid it on December 1. I debit insurance expense, $2,400, and I credit cash, $2,400 on December 1. Yeah. And the rest of the months it's zero. Right? So what does that do? What's the difference? The difference is, and the reason why accrual accounting is better, is because it recognizes the consumption of the expense when it actually happens. Otherwise, you look at this and you say, wow, your insurance expense was real high in December. What happened? Well, I'm on cash-based accounting, so I recorded my insurance expense for 2 years. You won't see insurance expense show up for 2 years thereafter, right? So that's the primary difference between the two systems. Again, it's more effective for businesses to use accrual-based accounting, and that's why we focus on accrual-based accounting in this course. A lot of that has to go back to, as we mentioned, is the revenue recognition principle that we talked about on the first day of this course, and the expense recognition principle or matching principle. For revenue recognition, this principle requires that we record revenue when it's earned. That means that I record the revenue when I have delivered the good or the service to the customer. You see? And I record that revenue by the amount that I expect to receive. Yeah? That's revenue recognition. The expense side of that, the matching principle, expense recognition principle, tells us that we record the expense when it's incurred. It matches with the revenue that was earned during that same accounting period. Okay? So, going back to my earlier example, we made a bunch of sales in the month of January. On February 10th, I received my Pepco bill. And it's for electric consumed in the month of January. The reason why I consumed that electric is because I was making sales at the store, you see? So I need to record that expense with the revenue, you see? Make sense? Those are the two principles that we follow, especially as we talk about accrual-based accounting. Now, I mentioned that, today we're talking about adjusting entries. We make adjusting entries because we need to recognize the consumption of expenses from prepaids. We call that deferral of expense. We need to recognize the earned revenue from unearned revenue, meaning we had a customer that paid us in advance before we delivered the good or the service. We call that unearned revenue. It becomes earned revenue when we provide the good or the service, you see? And so we call that a deferral of revenue. We also have what's called accrued expenses. Here's what I mean by this. Over time, an employee works 2 weeks. Okay, so let's say you're an employee of the company, you work 40 hours a week for 2 weeks, and then you get paid for the prior 2 weeks of work. You see? As you're working, you're accruing your wages. Okay, so every 8-hour shift, you're accruing 8 hours worth of pay. You see? For the business, that's called an accrued expense because I got to pay you wages, right? So an employee works for the business records the hours worked times the wage amount to equal the accrued wage expense. At the end of that 2 weeks, the business pays you. But during those 2 weeks, you're accruing wage expense, you see? And then we also have what's called accrued revenue. We are recognizing revenue as it's earned over time. And then we have to make some adjusting entries based off of who didn't pay us or who paid us. See? So those are the 4 reasons why we make adjusting entries. There is a 3-step process to making adjusting entries. Okay, the first step is to determine what the current account balance equals. Yeah, I'm matching what my statement says to what my account says, my accounting system, my QuickBooks. Okay. Oh, does it match? We got to get it to match. So step 1, determine the balances. Step 2, determine the current account balance, what it should be equal to. Okay, I got my statement, I got my accounting system. One of these is incorrect. Okay, it's probably the accounting system. I gotta balance it. So I need to make an adjusting entry. In step 3, I record the adjusting entry based off of the first 2 steps. Right? So 3-step. It's a very easy process. The steps are more confusing than the actual process. So you might be wondering, well, Dr. B, you keep saying this adjusting entry. What is it? We make it at the end of each accounting period, usually each month, to reflect a transaction or event that has not yet been recorded in the accounting system. For example, the consumption of the insurance expense from a prepayment. Each adjusting entry affects one or more income statement accounts and one or more balance sheet accounts, but it never affects the cash account. You should never see an adjusting entry that has cash involved because it never involves cash. See? I'll explain more of that as we go through the examples. So I'm going to go through a series of examples for adjusting entries where we have what we call a deferral of expenses, like prepaid insurance. So here we have what it looks like. Okay, prepaid expenses like prepaid insurance, prepaid rent, a prepayment for supplies are assets paid in advance of receiving the benefit, receiving the expense. Okay, the consumption of it is what it should say. So I make an adjusting entry to recognize the consumption of this. I debit the expense, like insurance expense, and I credit prepaid insurance to reduce that prepayment. Remember, prepaid anything is considered an asset account. Remember, we talked about that. The reason why it's called an asset is because I could cancel that, and take that cash back. All right? That's why it's an asset. So, first example, prepaid insurance. December 1, I made a payment of $2,400 for 24 months or 2 years of insurance. So, I debit prepaid insurance and credit cash. That's the journal entry I make to pay the prepayment, on December 1. At the end of December, I need to make an adjusting entry to reflect the consumption of 1 month worth of insurance. So the way I do that is I debit insurance expense and I credit cash. You'll notice that I do that at the end of the month, and I do that at the end of every single month for 24 months. Okay, so on December 31, I make the date, December 31, for $100, I debit insurance expense, and I credit prepaid insurance. I do that every month for a period of 24 months until the balance of prepaid insurance reaches 0. This is what it looks like on the T accounts. Yeah, just to kind of show you visually what it looks like on the T accounts. You see that prepaid insurance is an asset account, insurance expense is an income statement account. I'm affecting both of those, right? So my insurance expense goes up, my prepaid insurance balance comes down. Debit insurance expense to increase it, credit prepaid insurance to decrease the asset account. And this is what that journal entry looks like, just as I had said before. Put the date, debit, insurance expense, credit, prepaid insurance. And then you'll see the little note. Okay, here we have another example. Adjusting for inventory or supplies. Okay. The book likes to call inventory supplies. It's inventory. Okay. Here we go. Step 1, we figure out what happened, right? The balances. The company purchased $9,720 worth of supplies in the month of December. We consumed some of these supplies during the month of December. Okay? Meaning we used some of our own inventory for whatever purpose. Okay, great. So we do a physical inventory count at the end of the month to figure out how much we used. And it shows that the unused balance should have been 8,670. Okay, so that means during the month of December we used $1,050 worth of supplies. Okay, so here's what we do. We make an adjusting entry. We debit supplies expense, $1,050, and we credit supplies or inventory, $1,050. That decreases my inventory, increases my expense. The expense is an income statement account. The supplies or inventory is an asset on the balance sheet. You see? And it updates my balance on the balance sheet. And as I mentioned, debit supplies expense, $1,050, credit supplies, $1,050. That's the adjusting entry that I make. Okay. There's another type of adjusting entry that we typically make at the end of every year. And it's for this concept called depreciation expense. Fixed assets like property, plant, and equipment, they lose their usefulness over time. Right? Think about it. Think about a vehicle. Okay, the company owns a vehicle, you own a vehicle. As it gets older, it kind of loses its usefulness. It's got a lot of miles on it, starting to break down, not as useful, right? The same concept applies in accounting. As assets like a vehicle, a building, equipment, they use their usefulness. Yeah, as they get older, they're not as useful. It's because they wear out. Yeah, they break down, they lose their usefulness. We call that process of losing its usefulness depreciation. It's depreciating in value. It's losing its value because it ain't as useful as it used to be. Okay? That's why, you look at if you buy a vehicle. Okay, let's say you buy a brand new vehicle, you drive it off the lot, it loses its value immediately. Why? Because you're using it, right? So every year that you're driving around in this vehicle, it's losing its overall usefulness. Yeah, because it's getting older. You're using it, you're consuming it. It's losing its value. So property, plant, and equipment lose their usefulness over time. We call that depreciation. There's a couple of different formulas that we use to calculate the depreciation expense. The most commonly used one is called straight line depreciation. And the way that we calculate that is we take the cost of the asset. Let's say it's a piece of machinery that we bought for $26,000. Okay, the cost is $26,000. It has a salvage value. The word salvage means what is it worth at the end of its useful life? Scrap value is another term for salvage value. It's what is it worth in the end? What's the metal worth, right? After its useful life is done. In this example, we're going to say it's $8,000. Divided by useful life. Useful life is how many years is it expected to last? Yeah. In this example, we'll say 5 years or 60 months. So, straight line depreciation, probably the most commonly used depreciation method. It's the easiest to calculate. There are a couple of other ones that we'll talk about, but for all intents and purposes, we'll go with straight line. Make things easy. So again, here's the example. We purchased the equipment for $26,000. Its useful life is 5 years or 60 months. It'll be worth about $8,000 at the end of its useful life, also known as scrap value or salvage value. We purchased the equipment on December 1st, and here we are at the end of the year. This part's important to know. It's all about dates, especially when it comes to adjusting journal entries. It's all about the dates. Okay, so we bought this piece of machinery brand new, expect to last 5 years. It's only been in service for 1 month during the year that we bought it. You see? So we need to account for that 1 month as an adjusting entry. I'll walk you through. But first, let's figure out the depreciation expense for the machine. Original cost was $26,000 minus the salvage value of 8 gives us a net cost of $18,000. We divide that $18,000 by 5 years or 60 months. Okay, so if we do it by month, we can figure out how much we need to depreciate it by for that adjusting entry in that 1 month, right? So we go through the calculation. Cost is $26,000 minus the $8,000. Salvage value is 18. 18,000 divided by 60 months is $300 per month for 5 years. Okay. Therefore, we bought it on December 1. Now here we are at the end of the year, December 31. We need to record an adjusting entry to recognize 1 month of depreciation expense. So we recognize it this way. We debit depreciation expense and we credit an account called accumulated depreciation. Accumulated depreciation is what we call a contra account. Okay, contra flow. It contradicts the original cost of the equipment. Contra. It's in contra to the equipment. The reason why we do it this way is because we cannot just simply reduce the original cost of the equipment by its depreciation expense. It doesn't work that way. Okay, so what we do is we have an account called accumulated depreciation that is in contra to the asset, the equipment. So on your balance sheet, you'll see equipment 26,000, and then you'll see also under fixed assets, you'll see accumulated depreciation as an asset account, but it holds a negative balance. You see, that's how it contra flows. So we debit depreciation expense, credit accumulated depreciation. What this does is it recognizes the consumption of that value of that usefulness by $300 a month. So debit depreciation expense by 300, credit accumulated depreciation by 300. That's the adjusting entry that we make at the end of that first year, because remember, we bought it December 1, which means we have 1 month of depreciation to recognize in that particular year, in that accounting period. In the subsequent months, at the end of each month, we would debit depreciation expense, credit accumulated depreciation, $300. That's one way of doing it, or you would do it by the full amount at the end of each year. Okay, and then as the months go on, you'll notice that the accumulated depreciation, because it holds a negative balance, brings the overall book value, or what the equipment is worth, to its realized amount. What I mean by that is because the equipment loses its usefulness every month as it's being used, it reduces its overall value. We call that book value. Book value. It shows what the equipment is worth at a particular point in time. Yeah. Okay. So that is a deferral of expense. Let's talk about a deferral of revenue. Deferral of revenue is like unearned revenue, right? I didn't earn it yet. They paid me in advance. Customer paid me in advance of delivering the good or the service. This is real common in like lawn care. Lawn care, sometimes they do plowing during the winter, and during the summer they take care of the lawn, right? Lawn care. Lawn care businesses, typically the way it works is they have a contract with a customer. Customer pays the company in advance of providing the good or the service. When that happens, it creates what's called unearned revenue. The company didn't earn it yet because they didn't provide the service, the good or the service. And so when that happens, we increase the liability and we increase our revenue eventually. Yep. So, yeah, that happens. We debit cash and credit unearned revenue when a customer pays us in advance. So here we have an example. Our company is in consulting. We do consulting. And a customer paid us in advance, $3,000 for services in the future. Okay, great. And this happened on December 26th. It's for consulting services starting the next day, going through February 24th. I can already see a few issues with this transaction, right? Because the year ends December 31, this contract started December 27th. So that means I need to account for a couple of days in this first year. 27, 28, 29, 30, 31, 5 days. Okay. So the contract was for $3,000. So we debit cash, $3,000 to increase our cash, and we credit unearned revenue, $3,000. We do that on December 26th. Now, there's 5 days in the new year under this contract. So we got to make an adjusting entry, right? For those 5 days. So on December 31, I need to make an adjusting entry. And so we figure out that it's $250. How do we figure that out? 5 days out of 60, which is the length of this contract, 60 days, times the amount gets us to $250, right? So on December 31, I'm recording adjusting journal entry. I am going to debit unearned revenue and credit revenue, right? To recognize that I've earned the revenue for those 5 days. You see, that's why we make adjusting entries. And you'll notice what happens to the balance. Unearned revenue is coming down, and revenue is going up by that amount. So, and the journal entry again is debit unearned revenue to reduce the unearned revenue, and we credit revenue to increase the recognition of the revenue. So that's revenue. The next area is accrued expenses. And then we'll do accrued revenue after that. So accrued expenses. These are expenses that were incurred in a period that were both unpaid and unrecorded. Unpaid and unrecorded. An example of this, as I had mentioned before, is wages. The employee worked for a couple of days in the prior year. Now here I am in January. They're still working, and I got to pay them at the end of the 2 weeks, right? I need to recognize the time and wages that they worked for in the prior year, right? So I can pay them, so I can record that expense appropriately. we call that an example of accrued expenses. Okay, they're liabilities that were incurred and they have not been yet paid and not yet recorded. So we got to record them with the adjusting journal entry. Other examples besides wages or salaries include things like rent, taxes, interest, those kinds of things. So here we have an example. We got an employee that earned $70 a day or $350 for the first five. I'm sorry, they earn $70 a day. If they work 5 days a week, that's $350. Salaries are paid every 2 weeks. Okay. So it just so happens that the end of the year is on a Wednesday. So we need to record the 3 days, Monday, Tuesday, Wednesday, that fell into the prior year. So here we make the adjusting entry. 70 times dollars a day times the 3 days, that's 210. So I make the adjusting entry. I debit salaries expense 210. You'll notice the date, December 31. And I credit salaries payable 210. Remember, salaries payable, that's the accrual account. It's an accrual expense, yeah? I accrued the expense, the salaries expense, into salaries payable. And I'll pay the employee when they work the rest of the time, the remaining week and a half, right? So what happened with that at the end of the month? Salaries expense went up by 210, wages payable went up by 210. And then eventually I need to pay my employee. I'm going to pay them in January. Yeah. So the way that works is I take the amount that they worked, that they accrued, the 3 days, $70 a day, 210. So I debit that amount because I'm going to pay them that. I'm also going to pay them the remaining time that they worked, another 7 days, right? 5 days plus the 2 from the prior week. So 7 days times $70 a day, $490. Then I'm going to pay them that full amount. Credit cash, $700. You see? So that's how an accrued expense works. That's the type of adjusting entry we would make. And then the last part is accrued revenue. An accrued revenue happens because the company delivered a product or provided a service that has not yet been recorded in the revenue for that accounting period. Yeah, it happens sometimes. Oftentimes when it comes to accounts receivable, for example. So we may need to make an adjustment with accounts receivable that falls into more than one accounting period. Yeah, as an example. So let's go through an example like that. So here we have a customer that signed a contract with us for $2,700. They signed that contract on December 12th. On January 10th, I'm sorry. On December 12th, the customer agreed to pay us the $2,700. On January 10th of the next year for future services. Okay, in other words, they set up an account receivable with the company. Customer says, "Hey, I'm going to pay you the $2,700, but I'm not going to pay you until January 10th." Okay, cool. On December 31, we need to recognize the 20 days worth of service that we provided and earned but have not yet collected on. Because remember, the contract went into effect on December 12th. The customer is not going to pay us until January 10th. So for the 20 days at the end of that first year, I need to recognize how much they owe us for the amount that we've already performed. And the way we do that is we take the contract amount, in this case 2,700, times 20 over 30. 20 out of the 30-day period for this contract. That comes out to $1,800. So we make the adjusting entry. We debit account receivable, $1,800, and credit revenue, $1,800. And you'll notice that because it's an adjusting entry, we make that date for the end of the year. And the effect on the balances, accounts receivable went up $1,800 on the balance sheet, and on the income statement, revenue went up by $1,800. Now, time went by. Now here we get to January 10. The customer agreed to pay us the $2,700 on January 10. So we debit cash $2,700. We credit accounts receivable $1,800. Remember, that's from the prior year to reduce that account receivable by that amount. And we credit consulting revenue $900. Why $900? Because we already recognized $1,800 of it in the prior year. You see? So these are reasons why adjusting entries are really important. Make sure that you get the dates right. The dates are really important when you make adjusting entries for these reasons. Yeah. So we talked about the 4 primary reasons why we make adjusting entries. Deferred expenses, deferred revenue, accrued expenses, and accrued revenue. Those are the 4 reasons why we make adjusting entries. Remember that we never affect cash when we make adjusting entries. Okay? That's just, yeah, that's the way it works. This slide shows us the connection between accruals and deferrals. It just kind of shows you, summarizes the impact and the type of entries that we make. This slide really kind of puts it together, all of the examples that we went through for all 4 of those particular reasons why we make adjusting entries. So I really like this slide. Just saying, it'll help you, especially on the quiz, as a hint. Yeah. Okay. One of the last things we do after we make all those adjusting entries, we got to make sure that our accounts balance. Okay, we got to make sure our debits equal our credits. And the way we do that is through what we call an adjusted trial balance. You may remember, we used to have what's called an unadjusted trial balance. I think we talked about that last week, where it's a list of all the accounts and their balances before any adjustments were recorded. That's why we call it the unadjusted trial balance. So this Excel file here, this shows us what we call the trial balances. On the far left side, those are the account numbers. Then the next column is the account titles, the names of the accounts. You remember, they go in order of liquidity. Yeah. Then the next 2 columns, debit and credit side, shows us the unadjusted trial balance. These are the balances before we made the adjusting entries. Now, then we show the balances of all the adjustments that we made. Okay, These letters represent all of those example transactions that we went through, yeah? We then formulate what we call the adjusted trial balance based on the unadjusted amount to the adjusted amount. You see? Unadjusted amount, we make the adjustment, then we find the new adjusted amount, right? That's how we get the balances in the adjusted trial balance. Okay, you'll notice that at the very bottom, your debit amount always equals the credit amount every single time. Unadjusted, 45.3 equals 45.3. Adjustments, 37.10 equals 37.10. Debits equal credits. And in the adjusted column, 47.6 equals 47.6. So that's how you know you're doing it right. It's when the debits equal the credits, and this is the process that we follow for making the adjusted trial balance. It's a 4-step process. The first step, of course, is to, that process is a 3-step process. Unadjusted, find the adjustment balances and the adjusted balances. Once we've done that, once we've gone through this adjusted trial balance, we can prepare the financial statements. The financial statements are going to show the accurate balances because we made the adjustments and then we verified those adjustments through the trial balance. Okay? It's a 4-step process to create the financial statements from the adjusted trial balance. The first step is to prepare the income statement from the revenue and expense accounts from the adjusted trial balance. Then we prepare the statement of owner's equity, also known as the statement of retained earnings. And we do that from the equity minus any withdrawals based off of the net income amount that we got from the trial balance. In the third step, we prepare the balance sheet from all the assets, liabilities, and equity accounts from the trial balance. And then the fourth step is to prepare the statement of cash flows based off of any changes. There's not going to be any changes, really, the statement of cash flows, because we didn't affect cash. So here's what it looks like visually. This is, again, how the statements are connected. It's a 4-step process. Okay. So now we've went through the process of making adjusting entries. You learned about the four reasons why we make adjusting entries. Then we learned about making the trial balance based off of those adjusting entries. Now we learned how to make the financial statements. The last thing I need to tell you about, and I do this in every class, is a couple of ratios. All right. I know you love your ratios. So real quick, this one's nice. I like this ratio. This is probably one of my favorite ones. Profit margin. In business, you got to know this ratio. Super important that you know this ratio. The profit margin ratio. It measures the company's net income to sales. In other words, it measures profitability. Yeah, we calculate this by dividing net income for the time period divided by net sales from that time period. Yeah, so net income divided by net sales. Both are found, of course, on the income statement. A higher profit margin, the better. Yeah, so Yeah, it basically tells us from every sales dollar how much of that was profit. Yeah, that's what profit margin tells us. That's why it's super important in business. Okay, and then just visually, just to kind of recap the methods, right? Remember, we talked about the accrual-based accounting, which is what we're going to focus on in this course, and the cash-based accounting. We talked about the methods for payment. Yeah. For cash-based accounting, we recognize it when the cash is paid. For accrual, we recognize it when it's incurred, when it happens. So just keep that in mind. We talked about that at the beginning of the lecture. This just compares the two, right? This just kind of recaps that as well. Again, just comparing the revenue, the accrual method versus the cash method for accounting. Yep. So, my friends, we made it to the end of chapter 3, adjusting entries. Just to remind you what you need to do this week, because we only hold lectures on Tuesdays, here's what I need you to do for Thursday. For Thursday, you need to create 2 original annotations in Hypothesis. Okay, how to use Hypothesis is right here under Engage and Explore, video annotations. Watch that, shows you how to make the hypothesis. Then you come in here into the hypothesis and you will watch the video, you'll record, you'll highlight area of interest, you'll make a comment. Here we have 2 of your classmates have already done this. Thank you, Maria. Thank you, Camille. Already done this? Great. So you'll create 2 of those. Yep. 2 original hypotheses. When that's done on Thursday, after that, you'll come back into the classroom between Friday and Sunday and respond to 2 of your classmates. Okay? So that's how the hypothesis works. Please make sure you do your original ones by Thursday, respond to 2 classmates by Sunday. And then, of course, you have the Chapter 3 quiz. So those are your 2 primary action items for this week. Any questions?
Professor,
Yes, Marlon.
I have a question about chapter 3. If I'm having any difficulty understanding some of the concepts, can I make up an appointment with you for Thursday?
Yeah, absolutely. Definitely. That sounds good. Yeah, shoot me an email with the time that you want to meet.
Okay, thank you.
Awesome. Yeah, my pleasure. Great. Any other comments, questions, or concerns about what we covered today, about homework, anything like that?
Yeah, no tricky questions, please.
Okay. I'll try
Tricky
my best,
question.
Mohammed, you know. I'll try my best. Too funny. Okay, well, again, thank you all so much for your time today. Really do appreciate it. Appreciate all of you being here. Let's do our best to make sure that our work gets done on time, every time. You know how it is. I don't want, don't fall too far behind because it gets risky. Yeah. But thank you all so much for your time today. Appreciate all of you. If you ever need anything, you can. Thank you. Thank you so much for being here, Ty. You can email me, call me, set up office hours, whatever you need. I'm always here for you, okay? I am here for your success. I want you to know that. And I'll do everything in my power to make sure that you're successful. And anytime you need help, I am here for you. I want you to know that. All right? So, again, thank you all so much. Appreciate all of you. Have a wonderful rest of your night. Thank you so much.
Thank you, Professor. Have a good one.
Take care. Bye-bye. Thank you.